improve financial efficiency and growth. Ladies and gentlemen, the co-founder and CEO of FlexLease. नाम ऐसा है कि नाम सबने सुना ही है. Ladies and gentlemen, Rahul Sareen. Clap it up for Mr. Sareen, please. As the popular dialogue goes, Rahul naam to suna hoga, right? That's exactly how it is. Thank you so much, Mr. Sareen, for joining us over here. My next speaker, after schooling at Winchester College in the UK, he earned a Bachelor of Science degree in Architecture as well as a Master of Architecture from the University of Michigan. Having worked on projects as diverse as theatre set design and heritage hotels with boutique architecture from K Ni Tan Architects in Singapore, he's joined the award-winning team at City Architects in Mumbai, recognizing the need to provide path-breaking thinkers with a workspace that offers all the finesse of a top-notch office space with none of the fuss involved in maintaining it. He founded Dextrus in the year 2018. Ladies and gentlemen, the honorable founder and CEO of Dextrus, Robin Chabra. Can we please have Mr. Chabra over here on stage? Thank you so much. My next speaker over here, ladies and gentlemen, an IIT Delhi graduate, is the honorable CEO and co-founder of MyHQ, India's largest marketplace for commercial real estate. Founded in the year 2016, MyHQ is backed by Anurag and present in 10 plus cities with over 10,000 commercial spaces. I don't have to call him anymore, he's already here. Ladies and gentlemen, Utkarsh Kawatra, co-founder and CEO, MyHQ by Anurag. Thank you so much. The stage is set. The panel is ready. We'll follow the momentum. Can you all please once again clap and appreciate their presence over here, everyone? It's not every day that you get so many incredible people all under one roof with their busy schedules. And over to you. You have the timer for your reference there.
Hi everyone, good morning. Many facts have been said about the flex asset class and flex industry over the last 1 hour. So it'll save me some time, and I can just add that flex as an asset class has demonstrated a lot of value, resilience and growth over the past decade. In India, the flex stock currently stands at approximately 115 million square feet, making it definitely one of the largest flex markets, if not the largest flex market in the world already. With multiple leading flex operators now having extremely large multi-city portfolios. These portfolios have been built on the back of consistent and increasing end user demand, strengthening investor confidence, innovations in product and technology, strategic relationship enhancement with key landlords and channel partners, and increasing focus on compliances and implementation of customer feedback by leading flex operators. So with that quick background, now let's kick off this panel discussion. Hiren, my first question will be to you. SmartWorks by portfolio size is currently one of the largest flex operators in India. What are the advantages that this scale provides to your business?
Thanks, Pulkit. See, today, obviously, as you said, we have a very strong brand leadership, which has been there because of our sheer presence today across all the major micro markets in the country where we talk. And that is our strategy, right? We target all the major micro markets across the country. And with this strong position in the market today, we get a lot of pulse of the market, what is happening. So a lot of the demands which is moving in the market definitely comes to us because we are there, to serve all those clients in those particular micro markets. And that is how, we have the real pulse of the market. And also we are getting to see that paradigm shift, which is, I think the earlier previous panel also spoke that, while we witnessed that earlier, most of our clients were that 20-25,000 square feet, plus minus of a range. But now we can see a paradigm shift where we are getting those larger occupiers also who are looking to flex as a solution, right? So definitely being present across all the major macro markets today, we get to service all those kind of clientele as well. And secondly, because again, because we are present there across our developer partnerships are also very strong across all the major micro markets wherever we work across the country. And as again discussed in the previous panel, whatever our developers also look as a partners to us whenever they are also planning a large project or something across the country. So I think there are multiple advantages which we have today being present across the country and obviously being at such a large scale.
Got it. Thanks, Hiren. Can I ask the team to look at the reflectors or monitors here? It's echoing a lot. Okay, we can barely hear each other. There's somebody from the sound tech. There's so much echo we can't hear each other. You got reflectors, monitors. Yeah, but it's. नहीं तो हाँ, फिर तो Yeah, is this better? Can you guys hear me now? Okay. No, that of course. Okay, this is better. Perfect. All right. Thanks, Aaron. Pankri, Oyo Workspaces, of course, is a part of a large group, right? Which is the Oyo group. So, what are some advantages that you think you have of being part of such a big group?
Thanks, Pulkit, and good afternoon, everyone. I see three structural advantages being part of the OYO group. One, OYO itself is a large company present in 36 countries globally, and potentially was the first global company to run revenue management and customer experience with technology at scale. So the first interesting point is on the demand engine point. So overall global relationship with corporate enterprises, individual customers, managing the revenue, technology backbone. So that comes naturally to us when we manage Innovate also. Second and important point is on the technology and operations background. So the entire customer lifecycle management, yield distribution, revenue management, asset management, procurement efficiencies. So all of those benefits come to us at scale when we are as part of the group. And third and most critical point, which we see in now our journey when we are also scaling every year double on double. So the brand goodwill, where the relationship with institutional developers, because institutional developers are also looking to do mixed use assets now. So when we are interacting with institutional developers or large developers, one common theme comes at why don't we look at hotels, homes and office spaces together. So now we are talking in a combined and a synergetic way to get all of our portfolio working with developers. And second, as you know, it's a capital intensive business. So when we go and talk about raising capital for asset deployment, one critical important factor becomes the global rating of OYO through standard companies like Moody's, Standard and Chartered. So that becomes very critical for us to scale. So net, what I believe that we are a agile flex pair with a great muscle of a global platform. So that really works well for us.
Right. And do you find that there are a lot of similarities between the hotel business and the flex business? And do you see that is there a way to integrate both of them in the same asset?
At the core of it, again, three things. One, asset management becomes important, which is nothing but revenue management and occupancy. Second, obviously, is about service delivery. And third, I would say capital. So on all three places you see between hotels and the model that we run at Innovate, through lease management or revenue partnership, there is a lot of similarities. In fact, one basic metric that we track everywhere at OYO and Innovate is revenue to rent ratios. So it's very similar metrics that you see across both the businesses. Revenue to rent ratios, ancillary optimization, revenue optimization, cost of service, and then what product innovation that you're doing. So a lot of synergies that we see specifically when the global platform is also scaling along with us. So it's very apple to apple comparison. Slowly it's actually becoming more synergistic as we scale.
Robin, next one's to you, right? Of course, you run a premium co-working slash flex business in Mumbai, and you've started out of this city and you've sort of contained yourself in this city. So is there any reason you picked Mumbai market over the others? Is it more lucrative? And also as a follow-up, would you like to expand outside Mumbai at some point of time?
So, professionally speaking, I think I understand the city a lot more easily. Was probably why we started in Mumbai. But it's the financial capital. It has where the most presence of very large companies, MNCs, ends up being a big focus for us. So the entry level market is here, and it becomes a no-brainer as a result. Would we expand to the other cities? For sure. I think Bangalore and Delhi are no-brainers. We're amping up our planning for that, etc. And hopefully in the next year or 2 years, we'll have that entry made as well.
Got it. Again, I just request everybody to keep it closer. It's still a struggle to hear each other. Yeah. Again, Kash, sorry. Moving the next one to you, right? So you were one of the people to pioneer an online business for aggregation and let's say broking in the flex industry. So is that still the case? Is still most of your business online?
Yes, I think about 90% of our lead generation is still online. And that's essentially our moat, right? So we continue to be bullish online as the real estate market gets more mature. Uh, Corporates, whether it's a Reliance, whether it's a Tata, or whether it's a startup for that matter, they do look online in terms of the right options. And if the platform is able to explain it to them in a much more easier way, it'll help them ease out that, come to that decision faster. So the unique USP that we always want to create is we give them the fastest solution. And that is largely driven online. So yeah, that's a USP. Otherwise, we will be competing with you, right? So
But so would you call it online first or online at this point of time? Given
So-
that you also do these managed office transactions,
yeah,
that could require a lot of
so
offline.
it's online first. Real estate as an asset class is offline, right? So we have to be offline altogether. So the entire journey starts online and then is assisted with a combination of online tools and offline both. So that's how it is always. I wouldn't discount the offline element. We have people in each city, and we continue to hire more people. But we are hiring people at the back of a strong online channel, where we know even if a person is not from this industry, can achieve great with us while being in my HQ and do a lot of sales and help a lot of clients.
Got it. Got it. Thank you. Rahul, next one's to you, right? Of course, fit out leasing has been around for quite some time, and certain companies use it very extensively, and certain companies are yet to learn about it. So, for the benefit of our audience, could you tell us what exactly is fit out leasing as a service, and what is the problem it solves for?
Morning, everyone. So I think as a concept, fit out leasing is nothing but fit out as a service, where what players like us, we do is we invest in the fit outs on behalf of the clients and help them preserve their cash, make more tax efficient structures. Instead of owning the assets, the clients get to use the assets, which is the primary reason why they look for a solution like this. Is when you convert the capex to opex, right? The best thing that happens is that this becomes lighter on your balance sheet. But the problem that we are solving is just not for the enterprise clients. We are actually a problem solver for flex operators. We are problem solvers for design and build firms. We are problem solvers for enterprise clients. Because the way, we were hearing the numbers, 85 million square feet and so on and so forth. The fit out industry itself is about 220 billion. Last year itself, there's about 20 billion Indian rupees worth of fit out leasing that has happened in India. The primary reason, again, when there's large investments to be made, whether it is a flex operator or it is a client or the developer, all of them, they understand that investing anywhere where the asset grows makes more sense rather than an asset which is not growing, rather depreciating. So we're basically helping all these end clients of ours, whether it's a developer or the flex operator or a design and build firm, or even I'd like to call ourselves as sales enablers for IPC partners, where when we reach out to the clients and where the clients do not want to go to an operator. I'm also seeing there's a shift which is happening recently, is that a lot of clients are wanting conventional spaces rather than just operator spaces. They want a healthy mix of that. So what happens there? So that's where players like us, we pitch in and we ensure that we invest on behalf of the clients. We also have the design and build capability. So we can do design, build and financing, but we can only do financing as well.
No, Rahul, thank you. I just moved the next question to Mangesh, right? Of course, you come with a lot of experience in the entire real estate sector and construction, right? And we've heard 3 flex operators on the table. So what would be some good advice from you for them or for all flex operators? How could they sort of enhance their operations to deliver solutions faster, cheaper, and better for clients?
Good afternoon, everybody. With respect to the design that is ever evolving and the requirement of flex spaces is ever changing now. That is what I have seen. Even nationally as well as internationally, we need to see that the flex design does business transformation rather than only space allocation and carving out spaces with respect to the requirement of the occupier who is there, and it definitely enhances the absenteeism or the retainment of the client or whosoever occupies the spaces. The spaces should be designed in such a way that it takes care of all flexibility that is required for the occupier, whoever it is.
Thank you, Mangesh. Moving to Hiren again, right? You largely, or SmartWorks largely takes full buildings, right? And builds campus-like centers, and some of them are perhaps the largest in the world right now. So what's the thought behind it, right? Because of course it's high stakes game, right? When you take an entire building, there's a lot of risk that you're onboarding. So what's the thought behind doing that?
So yeah, I think this was a shift which we made, I think around 2018, 2019, where we started shifting from, smaller spaces to large independent buildings, campus. And now we obviously graduated to some large campuses which are almost 0.7, 0.8 million and close to that numbers. So the thought behind that, Pulkit, was also one of that, while, as you rightly said, that it's a risk when you take such a large building. But our thought was that, with doing that, we bring in a lot of, economies of scale into the play, right? So my acquisitions, my operational efficiencies, everything comes better when I do a large campus like that. Second, we thought that, there's a huge advantage for the clients as well, because they can't keep hopping from one space to another, if they keep continuing growing, right? So when I do a large building or a large campus, and because obviously, we follow strategy where there's a mix of, shorter duration, longer duration clients. So that also helps me to churn my clients better and give them growth opportunities within the building, right? So I don't necessarily give them an option to go out of my portfolio. The option is idea is to retain them as much as possible, help them grow within the portfolio. And with this large buildings, also one more thing, what we have done is the standardization, right? So each of my building has a lot of common areas, ecosystem, which we create, and then they are followed by own customized client offices, right? So when I follow this model, again, it becomes very easy for me to, replicate any client offices across the country. So another advantage what we get is the same client, now we are able as a focus strategy rather for us, where they continuously grow with us in other cities as well today, right? So that is helping us to keep our growth much faster. We retain the same clients, we help them grow across. And with this large building, full building models, we also, bring in a lot of operational efficiencies and economies of scale. And in fact, in one of the, I think, previous session, what they highlighted, that there is a high risk also when you do those large demand-backed transactions, etc. That is where also we feel that, our portfolio is very de-risked, because when we do these full buildings, our the largest client is not more than 50-20% in a single building, right? So that also, even if that churn happens in future, my cash flows on P&L for each building is also, I can sustain it better, I can make it more profitable, and there is not a huge sudden, dip in my profitability if a large client moves out. So I think it overall helps us in a lot of parameters, and that is why we purposely chose to stay with this model, and that is how we have been progressing with even larger and larger full building campuses.
Noted. And see, again, what I understand is one key part is you take on the large asset, but you also take on the management and maintenance of it, right? So that helps you with cost and quality control. But doesn't that sometimes limit you in terms of how many spaces you can acquire in here? Because there's only so many full buildings that come available where the landlord may be willing to give up full control to the operator. So is that sometimes a challenge or no?
So I think yes, it was, so, but again, if you see the transition has happened over a period of time. Last 6-7 years, we've been doing this. We started with smaller buildings, which are closer to 150, 200,000, and gradually we've been scaling. And, as the industry has been maturing, I think the developer mindset, which we again, referring to the previous session, that mindset is changing, right? So now, if you look at some of our latest acquisition, which are close to, 0.7, 0.8 million as well, that has happened because there's a developer confidence also that, this industry is there to stay, this industry is there to progress. And that is how, we have been able to secure more and more such assets also. So, a classic example for this city, maybe last year our number was 500,000. And from that straight away, we have made acquisitions of close to 1.5 million in this city, right? So we are touching 2 million, which is all across as a new. So I think that's the confidence which even the developer fraternity has on this overall business as or overall segment of managed office. That is why we have been able to acquire such large assets.
Noted. Thank you. Pankuri, I'll move to you again, right? So we started with the fact that OYO is an international business and there are many brands like Sunday and all that you have in other countries. So do you sometimes wonder taking your workspaces business international? Do you see the other markets have similar potential and appetite as India?
Absolutely. In fact, what happens is because Innovate is concentrated in India right now, our colleagues in other parts of the world reach out to us because when they go and speak to landlords to get more hotels or homes, the requirement comes that why don't you have one specific space within that hotel dedicated to a business center? So they reach out to us across globally. So that's something that we look at. But if I just see numbers where our focus is right now, globally, Flex would be 60 billion right now, expected to grow to 130 billion in the next 10 years. Global penetration is 3 to 5%. India itself is now 10%. So all of us see where the growth lies. It's absolutely India where the growth rate has already matured or even higher than the mature markets globally. But there is an aspiration to grow global. You might see us opening in Middle East soon. That is one thing that we aspire for this year. But India itself has so many opportunities with high GDP growth, GCC setting up, enterprise client doing investment, private companies doing investment to grow. And when with AI coming in and India still being the technology hub, we will see a lot of technology companies globally and India companies growing well. So I still see large opportunities in India, but there would be a brand pull absolutely coming from our global teams, and we hope to take that soon in key cities and key countries.
Oh, cheers to that and wish you the best when that happens.
Thanks.
Again, Robin, moving to you, right? So as a founder, of course, what's the most important financial metric for you to measure your business, right? So for example, certain people look at top line, certain EBITDA. Perhaps if I was a flex player, I would have looked at net cash flow, right? But as a founder, what's the most important factor for you to know if a flex business is doing well?
I think three really. That's always on my top of mind. I'd say is revenue to rent ratio will be important for you to keep an eye on always. Average rentals of your desk, to keep things very simple, they got to be increasing. If they're staying stagnant, then that's a sign of a lot of things. And the third aspect is client longevity. So how do you really measure that is very important over time. How sticky is the client? And that gives you the best analysis of whether clients like to use your facilities and they trust your service, they like your brand. Those are three things that I continuously stress about all the time.
So essentially revenue to rent, client longevity and average seat price.
Yeah.
And when I'm not sure if you've onboarded any investors, but when you're talking to investors, are there any financial metrics like, let's say, EBITDA or top line, which are their focus areas beyond these?
Yeah, sorry, I didn't say that part, but there's only one there. I just look at PAT. Sorry, yeah. I know contrary to everybody else's focus on EBITDA, I don't give a shit about EBITDA. I only care about PAT because depreciation in our business is massive, and you do have to keep an eye on that. CapEx investment is very important. So if you're profitable, unit profitable, that's what matters a lot. Otherwise, you will not sustain over the long term.
And before we move on from that, what as per you is the like for a market like Mumbai, what's a fair average revenue to rent ratio, like a good revenue to rent ratio for a city like this?
I think he should give that answer. Huh? But I usually try to keep 2.5, 2.5 as a
sounds more
minimum.
like it.
If there's a mismatch there, you got to understand why. It could be that rents are escalated, but people's expectation of seat rents is lower. There's a lot there. So yeah, I try to keep a fairly, that as a minimum. Yeah.
Yeah. Thank you. Utkarsh, moving to your world, right? So you of course dealt with a lot of clients who are looking at flex spaces and their demands are evolving. So in today's time, what are the most important things to occupiers, especially large occupiers that you deal with when they are selecting a flex solution?
I think a lot of it depends on the kind of sector the client is coming from. Like I think if you talk of BFSI, they are looking at more. Even in GCCs, we're seeing the IT setup requirements being quite high. So it depends on a sector to sector basis. I think if I have to put one base premise, I think everyone looks at the cash flows. That's the base premise where they're going in flex. And then bases each segment, I would say the kind of asks change. When you're looking at tier 2 cities, which a lot of companies are doing, they look at maybe a shorter lock-in. It depends on where they're setting up because that's more maybe experimental for them. When you're looking at companies which are hybrid, they're looking at access for, let's say, at a 50-seater, about 100-seater space, or 100 people access when you're taking a 50-seater space. So depends on a sector to sector, I would say. We can delve deeper into each sector. Yeah, but there's no one solution fit all. I would put.
And is there any sector that you've observed is the hardest to sell a flex solution to?
Good question. See, I think the numbers would point that out. If you look at all the sectors in commercial, the absorption versus the flex absorption. So ITIS was one of the first adoption. ITIS was the first one to adopt flex. BFSI, if you look at commercial, is about 20% in commercial, but in flex is still 8-9%. So BFSI is way behind in terms of flex adoption. Manufacturing is way behind in terms of adoption. So these two sectors, I think manufacturing, I don't think is suitable for flex for that matter only. BFSI, I think, is the next big shoot, which can adopt flex easily and is still a bit hesitant to, but will be the next big lever in terms of the industry.
Got it. Thank you. Rahul, moving on to you, right? You explained the entire flex leasing solution, sorry, fit out leasing solution really well and how it helps clients. But when an end user is choosing a flex leasing, fit out leasing company, how do they pick one better than the other? Like what is the criteria for selection?
I think the customers have become extremely smart today. You know, if you had asked me this question a few years back, there were a lot of loopholes in the industry that the customers were not aware of. But today, what the customers look at is an absolute transparency in terms of whether it is to, taxation related issues or it is to do with end of the term, how do you want to treat that? Because still fit out leasing has some aspects which are very ambiguous. You know, because most of the fit out leasing companies, they're offering classic operational lease to the clients where either the end of the term is not determined, not fixed, or the GST input credit which is available is not passed back very transparently. So I think one of the marquee factors that the clients look at is how transparent is the structure that you put across to the client. Second, I think what I have seen in the last few years is if you're able to give a one-stop solution to your clients, so for example, if I can do a design, build and financing and I can become one-stop solution provider to the client, it makes their life easier not to go and select other vendors, empanel them, then do empanel a leasing company and then, you're managing the rentals. So basically it's one cash flow. So I think a couple of factors, but I'd still say transparency being on top of it. Obviously, the clients are very brutal, and I'm sure that they're common in all the industries now. Price war is something that is at its peak right now, whether it is for flex or it is for hybrid players like ourselves. But commercials are no more just the deciding factor. The other factors are, I think, more critical now.
Thank you. Thank you, Rahul. Again, Mangesh, delving into your experience here, right? So, when a flex operator is choosing an asset for themselves, right, and especially players like Hiren who are, of course, taking very large bets, what would be certain advice you tell them to definitely look for in a building, as a development when they're choosing an asset?
See, for sure, you should be following the principle of modularization, standardization, and BIM is still there to actually convert and make us visualize what the product is going to happen. So I think if you follow these principles, you will land in a proper place rather than going elsewhere.
Thank you. That's great advice. Hiren, moving back to you again, congratulations on listing your company last year and doing so well. So, but has life changed any bit for how you operate your business before listing and after listing?
Thanks, Pulkit. So I think, from the day of inception till the today's journey, obviously we have been evolving. There's been processes, there have been governance. Everything has been changing over a period of time. And what I can say is that, previously also there were targets, there were goals, there were aspirations, what we have as a company. But now since we are public and, obviously there's a greater sense of responsibility it comes because, it's like all eyes are on you. So you have to be on the top of your game every time, right? So that's obviously we are, reviewed quarter on quarter. So yes, there's a stronger commitment, I can say, to deliver what we had. So obviously initially also every time we had our goals, aspirations, everything, as I said, but now it is all in public. So there has to be a very stronger commitment to deliver what you are, projecting, etc. So yeah, things are as business as usual, but it means that yes, there is a stronger commitment to what we say now, and we have to deliver.
And does that positively impact client and landlord behavior as well? Like, for example, when you want to acquire an asset, do landlords see you in a more trustworthy manner, and do clients see you in more credibility now that you're listed, or is that just the same?
Yeah, I think definitely, because see, what happens is once you get listed, obviously, there are a lot of audits, checkpoints, etc., which are all in place, right? So everybody knows that, your financials, etc., your credibility, increases in the market. So yes, from a client perspective as well as developer perspective, there's a lot of positive, which comes into play, and obviously it makes our lives very easier. To deal with a lot of this, especially the occupiers, which are large, in nature, and they have their own thorough due diligence. So in those such cases also, it helps us a lot in setting up our credibility to a certain level.
Got it. Thanks. And Pankuri, of course, sort of stretching that question out to you. The OYO as a larger group, of course, has been looking to list itself. But if, as the head of the workspace business, suppose, right, what would you prefer? Would you prefer to someday, I mean, just as a thought experiment, like listing your company, or would you rather run it as a privately held business? What is better?
So, if I talk about Innovate Workspaces is the only entity within the OYO ecosystem to raise its funds independently. So we raised a round last year because as you saw that this industry was doing well, the macro environment is in favor. We had a good product market fit, good unit economics, and that it made sense to have this separate entity grow and tapping funds from the market independently. So that was established last year. But as you know, listing is not only a financial outcome; it's an outcome of timing and maturity. From our perspective, as we scale, we have to scale with growth and profitability. Both of the metrics are critical. And then as we mature as a business, there is more predictability in terms of revenue. There is more operating leverage with scale. I think it will be a natural course to go and basically be on the market. And good part, what has happened is with Office, SmartWorks, WeWork, and multiple other players that have listed, the institutional investors do understand this asset class well. So I'm not the first one who has to go and explain. There are the explanation part of it is done well with so many listings, and the other part of it is definitely would be a metric comparison, the financial comparison. But I see it as a natural course of any business which is trying to grow. The market would appreciate if there are predictable cash flows. It would should take its own course.
Got it. And again, this is a question that I'll share between you and Robin, but starting with you, right? So, because you started as essentially a co-working company, which was innovator, and then of course you've been also diversifying into the managed business, right? So when you now run both of these businesses, which one do you think is the more lucrative and financial business? I know the market needs both, but as a business, which one do you find more viable and financially lucrative?
So from our perspective, there is a minimum cash contribution margin that we see for every hub that we operate or every center that we operate. And what works well for us with our size of every center is a good mix of an enterprise anchor client and high growth companies. So one gives you stability because this business has a mix of lease rental commitments and revenue share and minimum guarantees. And the other gives you better margins, but it comes with, let's say, a lower lock-in of 12 to 15 months compared to an enterprise lock-in, which would be higher. So one, on the revenue part, good mix of enterprise and high growth companies. Second, cost to serve becomes critical, and we do comparisons across all our hubs for every metric that way. Third, I would say would be, what efficiency can I bring together as a group, which we are working very closely, that how would the global scale help us in procurement? And contributes good to the unit economics.
Got it. Thank you. Robin, you have any additional or differing thoughts on this?
Yeah, I think I'm similar on what she's talked about. It makes sense. But I think it's not easy to answer that question in a 0 and 1 answer. I think managed comes with its own pros and cons, right? So the stability is great, but getting the client takes time. So there's also a downside. If that doesn't align, you're going to have a gap. Versus ready to go more flex office spaces, while the churn is higher, you also get clients who can roll in and out, and it's not that as difficult as waiting for the client. And the other advantage is usually you get a little bit more higher on the average rental per seat. So they can both work. It's really about how you play the mix, and it is together because you have a lot of economies of scale, benefits for both kinds of companies to be able to use all of that space. And I think if you get that ratio right, and your design plays a big role, you have to really think through various ratios, whether it's common areas or your private offices and et cetera, linked to your revenue. You have to get all of that right to get that right. And as a result, both work together pretty well.
Correct. So I was actually going to seek your opinion on that, what is the better solution, right? For example, for an operator to specialize in one kind and then scale in that, or for them to eventually, for an operator to develop both capabilities and offer both solutions to clients?
Yeah, I think you should. My point is you should offer both. I don't think they're that different. Once you figure out one versus the other, especially if you figure out enterprise, then doing the other is also easy. It's also a question of demand, right? Like if someone comes to you and says, I want 200,000 square feet of so-and-so space and things like that, you're looking at a very different dimension and how to solve for that. I would look at that differently. I would go out and look for space and make that space for them, etc. If that space has more space, and I think it makes sense for us to be there as in that micro market as also offering smaller offices, you would do that. So it gives you flexibility, but as a company, you should know how to manage both because it's in your interest to be able to then pivot depending on the kind of opportunity that comes up.
Yeah, makes a lot of sense. Thank you. Utkarsh, again, delving into your business and client experience, right? So of course we have 3 leading operators on the panel and many in the audience. today. So basis your general business and custom experience and customer feedback, is there some key advice that you'd like to give to the flex operator industry at large on what should be their key focus areas over the next half a decade to improve about their business and service?
I think the market will remain very fragmented. So I think it's very important for the flex operators to figure out what's their USP. Why should a client come in and use their space? I think that's one thing which some of the guys will have to figure out. I think some have done the back-end integration that the interiors costs are lower. So that works well for them, that they can actually reduce the per seat price and be more competitive. Others will have to figure it out how it works out. I think hospitality at its core needs to be upped in terms of the fragmented market. I think a lot of players lack the operational experience or expertise to ensure that clients stay with them longer. I think if I have to look at the industry overall as compared to hospitality, I think we are way behind there. And that's where I think there's massive room for us to work on. And that will be the key differentiator, I would say, for the players who succeed versus the players who do not.
Got it. Thank you, Utkarsh. So I see I've got 5.5 minutes on the timer. So before we go into more questions within the panel, I probably want to first check, does the audience have any questions that they want to ask any of the panelists? So we can prioritize that. All right, no. Okay, so just coming back to our sets of questions, right? Again, Rahul, just more curious about the fit-out leasing market. I think that's the different set of business in this room today. How big is the market size for this service in India?
See, I think the way we were discussing in the first session as well, somebody was saying we've already touched 100 million square feet, which means that, that amount of office has to be built up as well. And I mentioned there was about 200 billion worth of fit out that was done in, I think, last year or year before that, out of which about 20 billion was just done on fit out leasing bit. So I see a lot of scope, because we are not restricted to any particular industry, right? So offices will continue to grow, whether it's conventional, whether it is through flex or any other model changes. There will always be requirement to build up the space, right? And whenever that requirement is, the key question is, how do you fund it? I think that shift has happened after COVID. Nobody wants to invest. The developers, they don't want to invest. The clients, they don't want to invest. So somebody will have to invest. And the way, we're talking about the size of the market, I think it's not too far that by 2030, I think we should be touching about 40% of the market would go on a fit-out leasing mode. Now, whether it is catering to one particular segment or all put together, that I can't comment. But to a large extent, I think a larger portion, about 40% is what fit-out leasing should catch up.
And when you're pitching to clients, is managed solutions that the flex operators provide, is it a competitor or is it not a competitor to you, the managed solutions?
See, I think I'd say we are a hybrid model here, right? So when you talk about a managed solution, what is it that you're bringing on the table? So there is a space, then there is fit outs, and then there are services. There are only 3 components. The rest, everything is just ecosystem around it. How well do you do it? But the integral part is somebody will have to do the fit outs, whether they design, they build, or they finance. So I don't see players like us being a threat to them, but what I see is we are really complementing to them. We are actually going to be the single point of contact for a lot of large markets, because the flip side to this is that the banks don't see this real estate as a very positive industry. The banks, they see it very, very differently, whereas operational lease firms like us, we definitely see a lot of value in it. So I think it's very complementing in nature. It's not contradictory to that aspect.
Amazing. And again, last question for the day, and this goes to all the 3 flex operators, obviously. So what are your thoughts on M&As and consolidation in this sector, right? Do you think they are going to happen? They should happen? So Robin, starting with you.
Yeah, I think it should. It makes sense. But I think that what I've been, what I think makes more sense is having different types of brands within the same organization versus the same type merging with the other. While that could happen, and that probably is much more complex when there are two giants perhaps mixing. I think what would make sense is really the other aspect because what I see clients is basically when they're starting off, they might want very affordable space. Their business succeeds, their requirements change. They perhaps want an intermediate space over the next 3 years, and then eventually, if they're very successful and they're becoming large, they may even require a very premium segment, or part of their team branches off, and things like that. Front office changes from back office. There's a lot of that also that happens, and having that client stay with you, I think, is a very useful aspect of the business. And you could probably also then envision, just like hotels have loyalty points, all this other stuff could perhaps come in. And so there's a lot of opportunity if you think through that model correctly. It requires a lot of thought, but I think there's a lot of potential in that aspect.
Got it. Thank you, Robin. And Pankri, again, of course, Oyo Workspaces is, as a brand, is born out of an M&A, perhaps the first lucrative one in the industry. So why do you think a lot of them haven't happened after that? Like in the last 6-7 years, after that, we haven't seen many M&As. So what's changed as per you?
So at a group level, I think we did a large M&A in US with Motel 6. And that was close to 500 million. In fact, as a group, we are pretty active in M&A. If I come to Flex in India, again, as you saw, last couple of years was 20-25% CAGR. Every operator growing to 2x, 50-55% CAGR in their own business. And that also led to a lot of investment in supply. And in mid-margin, it also led to a lot of competition. So what we see is that as part of industry cycle, the consolidation should happen now. The capital access with the current numbers that you see on how the players are faring on stock exchange would mean that the capital access would become challenging maybe in short term. So that would
Anything you'd like to add, Hiren? Any thoughts from you?
So I think as she right